Good evening, Doc Severson here for the TheoTrade report for Tuesday, February 27th. We have about 20 minutes left before the cash market closes, and so far today we have seen a complete reversal. In fact, this so far is showing up to be a key reversal bar. We have a higher high and a lower close than yesterday. So a lower close and lower price point than yesterday, trying to fill that gap on the S&P 500. Now keep in mind that a single candle does not a reversal make. It's got to show a change in polarity before we see this move into a downtrend. And for that to occur, we'd have to see the market do one of a couple of different things here. Either we're going to have to see this hit a new low and then pop up to a lower high and then roll over. Or we would just see this thing set up with a lower high and then eventually a lower low. Now keep in mind that the way that price normally works around tops and bottoms is that tops are a process. So tops are a process. Typically we get a lot more back and forth, up and down before the price does release. If you want an example of something like that, you look back here, you look back here, back in 2015, 2016, those are good examples of how tops are a process before they finally release to the downside. However, bottoms are an event. Bottoms are an event really similar to what we saw in early February of this month, where we got very spiky behavior off of the bottom with heavy implied volatility. So today to me was all about uncertainty. Uncertainty. We have a new Fed chairman coming on board. Jerome Powell was testifying in front of Congress today, and the last two chairpersons that I can think of, which are Ben Bernanke and Janet Yellen, both, I wouldn't say tanked the market, but both created uncertainty on their first go-around. It's a very difficult job. It's very difficult to tightrope walk. Yellen actually got very good at it by the end of her tenure, as did Bernanke. Actually, Bernanke was terrible when he first came on board. He would say whatever was on his mind in front of Congress and would later, when he was confronted about that in terms of what he did to the market as he was talking, said that it was not his job to support the market. It was simply his job to support employment and set interest rate policy. Well, he eventually did kind of warm up to the job and figured out how to not only goose the markets, but also punish those against the agenda. If you look back on some of the options expirations that we had back in 07, 08, every time he had a big piece of news to come out, he would wait until the Friday morning of the monthly S&P settlement. We saw this happen in August of 07. We saw this in September of 08. And many other times after that point, he would know exactly what to do. So begins the tenure of Jerome Powell, and it's inauspicious one with the exception of this red candle. So across the board, we have the S&P is down just about 1% right now, just about 1%. Volatility is still relatively high. Something to keep in mind here is that we don't often watch this, but the Dow Jones transports are just getting crushed today, down over 2%, and really big time key reversal bar setting up in the Dow Jones transport. So the Dow Jones Industrials, again, are above that 61.8% retracement, typically showing higher probability of completing the triangle. But right now, it may be in doubt depending on how we consolidate and either break higher from there or consolidate and break lower. Now remember, if tops are a process, then what we would see is we would see a longer consolidation, maybe a more choppy, larger consolidation up in this area, and that would precede the release to the downside. So again, the point here is typically we don't see the price just reverse and head back down again. Typically on these types of moves, we see a lot more choppy behavior before we start to see that price release to the downside. And it usually takes at least a month or so of time to retest the bottom after a significant low. Now, something else to keep in mind here, and I'm switching over to the combination symbol that we have here: Facebook, Apple, Microsoft, Google, Amazon. These are the big drivers of the Nasdaq. You can see that they've taken over the new highs. But notice also, and I could see this across the board in just about every chart, that we're seeing Daily exhaustion. So now we have this uptrend, which has been a V-bottom in the heavy tech stocks. This is now into exhaustion. So we would, at the very least, expect to see a flag up in this area, a short-term consolidation. So I'm not looking too much into today's price action other than the fact that we have uncertainty coming in from the Fed. They were just saying on Friday how everything was sort of dovish and, hey, maybe we're going to pause once or twice during the year. Jerome Powell came in today and completely blew that assertion apart, intimating that we were going to see rate hikes across the board throughout the rest of the year. So keep in mind, guys, the markets are doing exactly what they need to do right now to recover from the insane rally that we had throughout 2017 and the first month of 2018. Again, let's go back to the S&P 500 and take a look at that. We have exhaustion on the monthly chart. This does not just go away. What this requires the price to do is a combination of going backwards as well as sideways, and as little upwards as possible in the near term until this is able to recharge itself. And the weekly chart is doing just that already. So we're actually recovering very, very quickly from this, and the market's doing exactly what it has to do right now to accomplish this fact. So continuing to rally above and beyond 2,900 on the S&P is going to put this right back into the crosshairs of exhaustion again, and we're going to get more and more of these types of shocks coming on board. Unless we're able to sit there and trade within this 350-point range in the S&P for the next, I'd say, 2 to 3 months at the very least before this is ready to roll again. And during that time, what we may see is a combination of consolidation, short term. We may see an attempted rally higher. We may retest the highs. Ultimately, we should probably end up retesting the lows or somewhere near 2,600 or so. So one of the things that you can do without paying too much for this, so normally you would say, well, let's just put on a straddle, but straddles are actually pretty expensive to play that. And you have to have massive amounts of movement for the straddle in today's volatility to pay off for you. So what you can do instead is just simply set up vertical spreads, out of the money debit vertical spreads at the price targets that you feel, buy enough time for these to work out, and they simply become very inexpensive trades. So in effect, you're building a virtual strangle, and you can use less time for the upside. You don't have to buy that much time for the upside. If there's going to be an upside attack, it's going to come in the next couple of weeks. A move to the downside probably will need more time. Again, tops are a process before they will eventually come down again. If you need to take a look at how this works out, typically you can go back to something like 2015, 2016 and see that type of character behavior in action. Bottoms are an event, tops are a process. Okay, so once again, the summary for today. Every new Fed chairman sticks their foot in their mouth on the first testimony. It happens every single time. Today was no exception to that. Number two, the market's doing exactly what it needs to do right now to work off the huge 2017 move into 2018. Number three, it's unlikely that we're just going to V-bottom our way out of this 350-point range without significant consolidation, without significant volatility, both to the upside and to the downside before this chart has earned the right to be able to move into its next trend, whether that's to the upside or to the downside. I don't care which way it is right now. We're only taking this about 30 days at a time. What you can do over the next 30 days is look for upside targets, either near the top of the range or down to about the 2,600 level to occur sometime within the next 4 to 6 weeks. We could also see both of those targets hit in the next 4 to 6 weeks. Remember, the overall picture here is bigger volatility within a 350-point range over the next 2, 3, 4 months or so. That's it for today's report, folks. Thanks for listening. We'll see you tomorrow.